Anyway, we're back. We're going to talk a little bit about what happened in the markets this week. A lot has happened, and it's best described in one word: schizophrenic.
Yeah, seriously. Yeah.
And I think what we're going to be kind of pointing to is everyone's so obsessed with every data point, and you don't control any of it anyways. Here in our local marketplace, as real estate agents or as loan officers or affiliates or whatever. Like, does it really matter in the end? And then also, it's an interesting week, right? Because we had the Dow drop 1,100 points on Fed Day when they did announce a quarter point cut, but also it came with the hawkish tone from Jerome Powell. And then today, fast forward 48 hours, the Dow is up over 800 points. And what was the other piece? PCE, producer or consumer price index. Did I say that right?
PCE, no. Oh my gosh.
Welcome to Squirrely Friday. We're gonna call it PCE and
Personal Consumption Expenditure.
Thank you, sir.
Yes.
The PCE is the Fed's favorite measure of inflation, and we've been getting some more, I would say, hotter prints than they would like. Not like out of control, but more than they'd like, in the 0.3 month range for CPI and PCE in the last 2 or 3 months. Mm-hmm. And wouldn't you know it, we have a very mild inflation print today, 0.1 month over month for headline and core. So it was less than expected. And that's what I mean, right? So we've got massive, wild swings in the stock market. We've got, oh my gosh, inflation's reigniting. And it's really frustrating because these are just single data points and everyone's like making these massive jump to conclusion, ideas around it. And it's ridiculous.
Yeah, I think that this is why people in the industry say don't try to time the market.
Yeah.
Right? Because it's so difficult. 2 days ago, it was like, oh my gosh, we're seeming to be in this new trend where rates are on an upward trajectory, at least for the short term, right? And then 2 days later, we've almost recouped everything that we lost on Wednesday. Not quite, but close to.
Yeah.
It's just so fickle. It's like day to day, it can have wild swings.
Yeah.
And this is for us watching it every day and being in the industry and mostly understanding how it works. So if you're just an average consumer trying to time the market, it's essentially impossible.
Correct. Yeah. And with guys like us, you'll drive yourself insane if you're paying too close attention. I'm guilty of that, by the way. I like to nerd out on it, so I can't help myself. But anything. Was there any other point we were trying to make on that?
No, just that it was bad. It's better. Maybe next week it'll be bad and better again.
Right.
It's like,
so
don't get too worked up over any single thing.
Yeah. And this week was a perfect example of that. And look, we're heading into holidays. My encouragement to people would be just to put that all on the back burner and enjoy the holidays. But if you happen to need to buy a home, still put that on the back burner and enjoy the holidays. I think his overarching point is like, if you're planning on buying a home and you're trying to let data determine or where interest rates are on any given day, or what the Fed says on any given meeting, decide whether or not you're taking action, you're kind of setting yourself up for failure, right?
Yeah. I just thought the presentation we're working on, we should add Logan Motoshami's, he has like by the year, the reason the market was going to crash, but didn't.
Yeah.
Right.
Logan Motoshami calls them doomers, right?
Yeah.
I think they're baby boomer generation guys on X or Twitter, whatever you want to call it, that are constantly calling for a real estate market crash. And to play devil's advocate, to a certain extent, I understand, right? It's not like I don't get the hope or the thought that there's a bubble, because COVID happened. We had 2.5% 30-year fixed. We had, in the COVID years, year-over-year appreciation was what, like 20% a year on average? Some markets more than that.
Yeah.
I think our market was more than that.
Yeah, and the FHFA price index was like 15%.
It's ridiculous.
Yeah.
So it's not like we don't all agree that inflation is destroying the fabric of our society. That's a different conversation, though, because with real estate, what we're losing sight of is that there's a supply and demand problem. That's it. I think it's as simple as that.
Yep.
And I know we talk about this all the time, but I think we need to continue to talk about it to remind everyone that the supply and demand problem isn't going away, at least in a lot of markets. Okay. Some markets needed some welcome corrections, right? And, my business partner runs a branch for us in Idaho near the Boise market. And you know what? In the last couple of years, that market softened and it wasn't a bubble popping, but prices did subside. And that was probably healthy because Idaho also happened to be the hottest market in the United States of America during COVID and the lead up to finally interest rates going up, right?
Yeah. I think it's a almost perfect analogy to what people in health always talk about, in that if you want to lose weight, you have to burn more calories than you consume. And just like there's different markets in real estate, there's different people that maybe your metabolism's a little bit better, so those numbers are a little bit different.
That's you, not me.
But the main driver that you always talk about is energy in, energy out, and in real estate, it's supply and demand.
Yeah.
Right. Regardless of what's happening and what the market is, it's still just supply and demand.
Yeah. Yeah. And look, interest rates are up, prices are up, but we have something called 337 million people in the United States of America and the shelter aspect. So not to belabor the point, I think you get the idea. But Logan Motoshami, like he's got every single year since after the great financial crisis, right? There's always a reason for why the real estate market's going to collapse again, and it never happens. And I'm sorry, it's just not going to happen. The only allowance that I'll grant on this is if somehow there is an international massive credit crisis that is so catastrophic that it leads to, international recession or depression and job losses become a problem. Yes, right. If there's something like that, a nuclear bomb goes off or whatever, yes, I agree. Things are going to go poorly, but we'll have bigger problems if that's the case. Then what are property values doing? So assuming that doesn't happen, expect real estate to appreciate another 3 to 5% this coming year in 2025.
Yeah. All right. Want to do a Mythbuster?
Mythbuster. Let's do it.
You have to pay off all your debt before you apply for a mortgage.
Incorrect. Yeah.
So I think that not only is that the case, it's almost the exact opposite, in that I would rather have a person come and talk to me before they've paid anything off than after, because I can assess where they are. And this is strictly talking about mortgage qualification, right? Because we're not financial planners, and it's not
a question of should you, right?
It's if you want to qualify for a mortgage,
right?
What do you do?
Right.
And I'd rather have liquid money that we can pull different levers on and say, we want it for a down payment, we do want to pay off debt, or we want it to buy down the rate. It's better to have the option.
Or we need to get strategic on, if we are paying down debt, which debts are we paying off?
And we don't want you to pay it off on your own. We want to pay it off through closing.
Yeah. Yes. Yeah. Maybe you can share that story so people understand.
Yeah. I mean, it happens where somebody, they're trying to do the right thing and they say, oh, I'm going to make my qualifications stronger, so I'm going to go pay off this car loan. Well, when you do that, it now needs to be documented, and some car loan people require you to put a check in the mail. So now that's 5 days with USPS, and they got to process it, and then they got to reflect it on a credit report.
Yes.
It's a lot of steps.
But this person, aren't they in escrow right now?
Yes. Yeah. That makes it more fun. So, but I mean, it's not isolated to them. It happens.
No, it happens all the time.
We try to prompt, but it still happens. So the much easier way is to pay it through escrow. So you just add it to the closing costs, and then the escrow company pays the car loan people, and there's far less steps and far less documentation.
Yes. So when in doubt, check with your loan officer first, okay? Because what happens is, with what he's talking about, is you send a traditional old school check in the mail to your car loan lender, and now it's a waiting game. Well, maybe that's okay if you're not in escrow to buy a home, but if you're in escrow to buy a home and you've got moving trucks scheduled, you've got contract contingency timeframes and close dates to meet, it's a little more serious, right? So I'm assuming that check probably got sent in the middle of an escrow period, and it's like, well, what if that takes 10 calendar days to process? And that was a big deal when it comes to your qualification, and you're supposed to close 4 days from now. right? Like timing really becomes a problem and the stakes go way up. So like with moving money around, and this is a bigger conversation, paying off random debts traditionally, not doing it through escrow like Mike's talking about, or I don't know why people like to play musical chairs with their money.
Yeah.
Well, I put it over here, then I put it over there, then I went up there and up down here. Like, and then it's like, you guys, I'm just letting you know that's okay. It's your money. But in an escrow period, or if it's within 60 days of buying a home, the underwriter's going to say, whoa, what's all this? Now you got a paper trail all of it and tell me what's going on. And you're going to be upset because you're like, why do they need to know that? And yeah, just don't move money around. Or if you're going to move money around, like I said, check with your loan officer first.
Yeah. And even if it's something more simple, like you needed to pay a credit card debt down to zero, it's just less documentation. So with moving money around for funds, with paying off debt, it's best to just game plan with a loan officer, and they're going to try to give you the best experience possible. We're all perfectly aware that documentation for a mortgage is just about the least favorite part for anybody when they're buying a house, right?
Yep.
So if we can reduce that as much as possible, that's the goal for everybody involved, for us and for the borrower.
It's coming from a good place. We want to help you.
Yeah. And I think that, you know, there's just a lot of maybe misconceptions or myths just because, I mean, people don't have NMLS licenses, but common question is, oh, how much do my student loans affect my qualification, right? And student loans, credit cards, they're usually the lesser of the evils because as a mortgage...
Minimum payments.
Right, you have minimum payments. So for most mortgage loans, I'll say, we're looking at a ratio of your debts on credit, and it's the monthly payment, not the balance.
Yeah, right.
So a lot of times a minimum payment that shows on credit for a credit card is like $25. And for a student loan, a lot of times it's 0.5% of the balance that we're using. Comparatively to a car loan, it could be $20,000 balance, but the payment's $800 a month.
Yeah.
That makes a big, big difference.
Right.
So that's why not paying anything off, just getting with the loan officer and let him or her pick or choose what makes sense is best. And then the other thing is that maybe you don't have to at all. If you have enough income, you don't have to pay anything off. It doesn't matter how much debt you have, right? So it's all relative to the situation.
Yeah. And you could use that money for liquidity or rate buy down or a higher down payment or whatever, right?
Yeah.
Yeah.
A new couch.
A new couch. Yes. Because at the end of the day, you're not just buying a financial instrument, you're buying a house.
Yes. Yep.
We could keep going or we can leave it there.
I don't know. I could talk about credit for another 2 hours if you want.
Yeah.
I'm joking.
Actually. So what was on my mind is, do we want to talk about supplemental tax bills? Do we want to talk about how and when you can remove mortgage insurance? These are things that have come up recently for me. And so I think the supplemental bill is the painful thing.
Yeah, because it's happening right now.
Yeah. So we'll end it after that. So this is... if this goes over your head, I'm sorry. My encouragement would be for you guys to reach out to us hearing this if you have a question on it and you want it broken down for your particular situation. But these are for folks who bought in the last year, right? So you just bought a home, whether it's your first home or not. It's applicable in California. And people get really confused by this. And the biggest confusion point is a lot of people get an impound account for the property tax and homeowners insurance. So the mindset is set it and forget it, right? So cool. I have an impound account for property tax and homeowners insurance. I'm getting these tax bills in the mail. One of them says supplemental tax bill. What's that? All right. Well, I have an impound account. I don't have to worry about it. Go sleep at the wheel, right? Wrong. All right. So you want to speak to that a little bit?
Yeah. In the first year, you get 2 tax bills per period. So a total of 4 in California instead of the 2. And the supplemental bill is a little tricky just because not every state has it. And these mortgage servicers tend to be national mortgage servicers. So they just don't know how to quite handle them.
Yes.
So while there's enough money in your impound account to pay it, not every servicer is going to or willing to. So to your point, you just got to keep your hands on the wheel, and it's great to reach out to the servicer and ask them if they're going to do it.
Yes.
And then even if they say yes, just go on the county website, depending on the county, it's
Yes.
easier or harder to find it. But nonetheless, you can see if it's showed as paid on the county website.
Yeah, and the explanation that's confusing, but I'll say it anyways, is what is a supplemental tax bill, right? Well, it's the bill where the county assessor realizes you bought the home, and now they're looking at the time period from the day that you closed and moving forward, and they're comparing that to the old owner's tax bill. Well, very likely your tax bill is bigger than the old owner's. So they're catching up the difference between that period of time, and that's a higher number most of the time. And all that means is they're trying to get you caught up. And you're going to get that bill, and it's not forever. This is a one-off situation that deals with that period of time, comparing the old owner's tax bill to what you should have been paying all along from the day you closed escrow. And that's the piece that servicers aren't in the business of trying to take care of unless you call. And then there's about a 50-50 chance they say yes. For me, I've noticed with my clients, it's generally less than 50-50. Most of the time, they say no. Now, people freak out. I wasn't accounting for that. And I understand. Now, the good news is it's just accounting. So, yes, you're going to have to likely make that payment. But at some point down the road, and you can even ask for your account to be audited, your impound account to be audited with the servicer, they'll realize they've got too much money in the account because you paid the supplemental bill, they didn't, and they'll send you that money back. So it's not gone forever, right? But accounting shenanigans. So this is the other thing. If you aren't required to get an impound account for property tax and homeowner insurance, my advice, even for first-time home buyers, you can do this. Do it yourself.
It's 2 payments. You can do insurance as 1 payment. I've had clients that they do the no impound thing and they're like, that did not work for me.
Really?
Oh yeah, because they just like it going out every month and it's consistent.
Yeah.
And
I understand.
I think, people that are variable income, self-employed, they're more used to that.
Yeah.
People that have a salary, they want the same in and out every month. It makes it easy. And there's some loan programs that give a small, but yet a small incentive to have an impound account.
Negligible at best, but yes, I see what you're saying.
Yes, so I think that there's reasons people do it, but yes, my preference as well is to keep it separate so you don't have to worry about all this, because you talked about the refund. That's now another set of steps you potentially have to go through is, okay, my servicer didn't pay it. I have to pay it. Now I have a surplus, so they're going to refund me. And now I got to make sure that they didn't over refund me. So I got to worry about the next tax bill. And it can be
exhausting.
A lot. Yeah. Luckily, it's just the first year and maybe trickles into the second year. You have to worry about this.
Think of it this way.
But it is a lot of accounting, as you said.
But think of it this way. You're used to paying your bills, your car payment, your various forms of insurance, your mortgage, whatever. Property tax and homeowners insurance are just another set of bills. Mm-hmm. Now, what you're doing with an impound account is you're asking a giant corporation to do it for you, along with thousands of others, right? So expect that it's going to feel clunky. And look, I get it. Set it and forget it's nice, but that doesn't mean forget it, okay? Like, if there's anything you take away from this conversation, because a lot of people are going to do the impound account, it's pay attention, right? When the bills are due, call the servicer. Okay, when are you planning on paying this? Hey, what's the supplemental? Are you willing to pay it? Don't just assume it's going to happen and you never have to worry about it. Because when you're relying upon a national servicing company and call center people who are poorly trained and you think it's going to go swimmingly all the time, sorry, it's just not the case. It's going to go okay, but mistakes can happen, misunderstandings can happen, and if you fall asleep at the wheel, it's probably going to burn you.
Yeah. So, I had another thing, but now it's escaped me, so maybe not.
Okay, no problem. Mortgage insurance is the other thing we're going to talk about. We're talking about credit.
Mm-hmm. So, in just that, it's not forever? Was that what you're thinking?
Yeah. Well, I mean, we could do a whole nother topic on this. Like, I can keep going, so I don't care, you know. But mortgage insurance is the thing that nobody really understands. Even I noticed a lot of lenders out there send a lot of misinformation on this, okay? 2 forms of mortgage insurance, right? Conventional or private PMI, okay, for conventional Fannie Mae, Freddie Mac loans. And then there's FHA, government mortgage insurance, right? Mm-hmm. And both are entirely different. So with FHA, by the way, in most circumstances, you're stuck with it forever unless you refinance, with a small caveat. We'll get into that. All these folks who are doing mortgage insurance on the conventional side, they're getting bad information, right? Oh, you can, you'll be fine in a year, just remove it. Don't listen to that advice, okay? If you're eventually wanting to remove your mortgage insurance, the good news is it's very possible. Now, there are strings attached. You have to have your mortgage insurance for a minimum of 2 years if you're going off of current property value. That's the piece that nobody says, which most of the time is not a big deal because it takes time, right? But after 2 years, you call your servicer. If you have, here's your pop quiz, Mike. What's the LTV requirement after 2 years?
After 2 years, you can request at 80. If you're based off of the original value?
Off the current value.
Current value.
75% is the number, just so you know.
75% to remove on primary?
I just looked at this, so I'm just going off of the Bill of Rights, MI Bill of Rights document I got from the MGIC, and it said 75 and not 80 after 2 years to go off current property value to remove.
That must be a
insurance.
change.
And it could be based upon servicer, but you see, there's confusion.
Yeah.
Right?
So I've definitely run into where if it's non-owner occ, anything but a primary residence, it's for sure not 80. I ran into that this last year.
Oh, okay.
Yeah.
Okay. Yeah.
So, yeah.
Yeah. It's that's the point. Right?
There's so many caveats because like the 2 year thing I would say is 99% true, but I know that some people will say, okay, if you've made improvements that enhance the value of the home, then maybe they'll allow for less than 2 years. So, but general rule is, if you want to use new market value, you're 2 years out, you're going to pay a couple $100 to have not a full appraisal, but some type of value given to the home. And I, of course, have a spreadsheet for this, but you could just do some projections.
We'll do a follow-up on this to confirm the nuance in terms of LTV requirements on primary versus non-owner.
Yeah.
I think I'm going to prove you wrong, but we'll see. I think it's 75 after 2 years to go off of current value, regardless of occupancy. That's my statement. We'll do a follow-up on this for you guys.
Yeah. For sure, if you're trying to use the original value, you can request at 20% equity, and then 22% equity, they have to remove.
But think about that original value, right? That means you're going to have to pay down your mortgage.
You've been making lump sum payments.
Yeah. And most people aren't doing that unless they
sold a house.
Yeah. Inheritance, small lottery.
Yeah.
They bought Bitcoin when it was low.
in which case, don't put it towards your mortgage anyway. Probably put it into an account that's growing at 8%
or buy more Bitcoin. I'm just kidding.
I remembered the bonus thing on the.
Let's go. Yeah.
Yeah. So Vivian can take it back into that section. Yeah. But so kind of a bonus, right? The other piece about an impound account is that somebody else is holding your money. Right. So
yes.
I've had clients do no impound account. And if you have the money up front, just stick it in a CD, like a 6 or 9 month CD, and let it grow for you. Yeah. And then it matures right when your bill is due, and then you have the money ready to go. Great idea. And right now, with rates being high, you don't even have to do
3 or 4%. For a 6 month CD.
Yeah. And, you could just even put it into a high yield savings.
Sure.
And every month, instead of paying a mortgage servicer, you pay yourself and let it grow a little bit.
Yeah.
Right. So that's maybe a little bit more advanced, but yeah, there's better ways to use your money than having it sit at a mortgage servicer.
That's a good life hack right there. I like that advice. All right. I think that's it.
Yep.
We've rambled enough, right?
Yep.
Thanks for listening, everybody. Until next time.
Happy holidays.
And Happy New Year. All right. Bye.